Good morning, friends. It is the 0DTE or 0 Days to Expiration podcast here on YouTube and X. And this is where we talk about. See, I was gone for a little bit, and so I had my other window showing this podcast. So we got a little reverb there, so we'll just move that. But anyways, this is where we talk about 0DTE trading, where we trade extreme asymmetry, looking for convexity. Today, we're going to do something a little different. It's how do I filter my trades? What do I look for? A lot of people are bent with trying to get closer to the money. Today, I guess I'll give you an excuse to get closer to the money, but I'll also show you why getting closer to the money in most cases is not worth it. So that's why it's a little bit of a dichotomy. I don't want you to look at today and say, Coach Ernie said that I should be going for lower delta because that's where dealer gravity is and that's where the money is. And I would say that, okay, there's a case to be made there. It's a little bit of tug and war, a little bit of friction. But what we're really looking for is the best risk-adjusted return. And that often means if we're right at where convexity is occurring, that means the rate of change of the cost of your fly is changing rapidly. I'll give you a concrete example. Let's say that you're putting a butterfly on and it costs $3. But then you go one strike out and it costs, say, $2.80. But then you go one more strike out and it costs $2.20. That's a big jump. You went from a 20-cent jump down to a 60-cent jump. And from a percentage point of view, it's way bigger. So you have to look at something like that and say, wow, am I better off going at the original strike I was at and pay the 10%? Or should I just go two strikes out and pay 30, 40% less? That's a no-brainer. And I'll tell you why. Not only are you paying less, which means that you're automatically also going after more, but the exact same move that you would get with, let's say you had a 10-point move or a 20-point move towards your strategy, that exact same move in a fly that's further out of the money because it has such a better risk to reward is actually going to pay more for the money that you put up. Now, it may not necessarily be more in an absolute term, but it could very well be the exact same payoff for being further out, meaning that you paid 40% less for the same money. You see what I'm saying? So you do that over and over again, and you become more efficient with the capital expenditure or the capital use of your money for putting trades on. And it will also mean over time that you'll be able to put bigger size on for approximately or something around your position size limits. And if you can do that, means that you're trading bigger for less cost. So that's ultimately what we're after. But there are some cases where a trade you might not see the convexity there. In other words, you don't see that big drop off in a price. It doesn't come for several strikes further out. And it might not make sense to move the fly way, way out there just to get a cheaper price. In fact, maybe the price is only changing by 10, 20, or 10 or 20 cents each strike that you go out, and you're wondering, it's not like falling off the cliff yet. It's kind of going like this, right? But it's way out here before it starts dropping. But let's say that your strike price is right here, and then the next strike goes like that. That's a big deal. All right? Hopefully that makes sense. And I'll show you some examples so that you can gain an appreciation for what I'm talking about. But we're looking for that convexity. We're looking for risk to reward that is better than what our target is. And it's not really our target. So when I say I'm putting on a butterfly that has 10% or less, the debit, it has to be 10% or less than the width. I'm not trying to find butterflies that exactly hit 10%. That's not my goal. My goal is to find something less than that gives me a really good deal. So it's like we're going shopping and we're looking for all the products that we'd be willing to buy, and they're all good brand names. But damn, this guy right over here, which is a top tier name, all of a sudden is 50% off. I'm going to go for that as opposed to go with this brand that's quite a bit more. 50% off, that means this one's 100% more. So I'm going to get the same benefit, but I've just put out way less money. And that's exactly what it's like when you're choosing your position here. You're going to find that pricing makes a big difference. And if you can repeat that over and over again, and then find that you're able to maybe add an additional position and still maintain your position size and get a much better price, now it means that your profits are going to go way up. You're still going to be very contained on your drawdowns, and you might not see it on that position, but if you do it consistently, you're going to start seeing a dramatic increase in your overall profitability over the long term. So many people are so hyper-focused on what happens right then. And if they've maybe had some bad luck over the past few days, a few losers in a row, and they're really aching for a win, and so they really want to push the trade closer to the money, thinking that's going to be good for them. And it's not. It's not that it's always the wrong decision. Let's see. I just noticed that I don't have a comment section up there. And, there we go. So we have James. How you doing, James? And Krukov and David. Let's see. David's asking, does that mean you recommend buying multiple contracts and sell them one by one at predetermined profit targets? No. I very rarely do that. So what you're really talking about, what a lot of people will recommend, is scaling in and scaling out. And that's really part of this idea of buying low and selling high, which is, believe me, is not the best way to make money. And unless you have a much larger account and you can afford to put on many positions, then you might consider finding your spots and maybe putting on a couple of different positions. But most people that have accounts that are in the $25, $50, or $100,000 price range are going to find that they're not putting on much more than one or two positions. So it doesn't make a whole lot of sense to break up, say, two positions into separate entities and then see if you can get an advantage, because you're just going to find that you're not going to get that great of an advantage. We're looking usually for one good opportunity in the morning to place a trade. So maybe that's probably the best thing that we should do. We should take a look at the opportunity that might be in front of us and how we would go about choosing a position size and whether we lean into it or not. And the way we're going to do that, although the market hasn't opened yet, but it will in about 4 minutes, we can start by setting this up and start looking at what we have. Hold on. I am just setting everything up. All right. Oh, a whole bunch of trades from last week. So anyways, today's presentation is going to be fighting against a little bit about what I'm talking about. There are filters that we use when we get into a trade. The very first filter is that I do not want to pay more than 10% of the width of my fly. And that is so that I get a proper risk to reward or a proper asymmetry in my trade. And that 10% of the width, if you do the calculation, comes out to a 1 to 9 risk to reward, which is, if you've been trading iron condors and things like that, it's completely flipped what you're typically doing. Like a typical iron condor might be 9 to 1, 9 parts risk, 1 part reward. We don't do that. That is a loser way of trading. Yeah, you might have a high win rate and you get that small little win, but you're also putting yourself at tremendous risk. And that means drawdown. Tremendous risk means it's inevitable that you will hit that risk at some point and wipe out literally weeks of profits. What we do instead is we take very tiny risk and we're looking to make it even tinier so that we can gain an extraordinary risk to reward and achieve something or find something that is a convex trade. And that is a trade that is just falling off the cliff, just right where most other traders are deciding that they don't want to go there. Where most traders are saying, I don't want to go there, that's exactly where you want to be. Now, there are cases when you use that initial filter of 10%, and you'll find that convexity doesn't seem to be real close to where you normally would be. So in other words, I'm at that 10%, then I go one more strike out, and it's maybe down, 20 cents. I go out another strike, and it's only down about 10 or 15 cents. I go out another strike, and it's only another 10 or 15 cents. So you're not really dropping a lot as you go further out, meaning that convexity isn't quite there. It might be way further out. Is it worth searching for it and go way cheaper and go way like 4 or 5 or 6 more strikes just so you can get a massive drop in the price? The answer is probably not. 1 to 9 is a really solid ratio. Where did I come up with 1 to 9? Let's see. There is a question here. Turning a symmetrical fly into a broken wing one, such as going from 30 to 30-25 wings, is a considerable way of sticking to desired short strikes while getting the fly cheaper. Yeah, and that is a technique, and that'll be a great topic for conversation on another one. And what I'll do is, although I wanted to spend this week on talking about this idea of dealer gravity, and we're going to go into it in great detail tomorrow and the next day, how we can manage our filter of what positions that we take. What you're talking about is by just shifting, if the fly is wide enough, the center strike out by 1 strike, you can create a huge difference in the amount that you would pay for that fly and get it super cheap. But you're also doing other things that are making the trade itself a little bit more difficult in the long run. But there are some instances where that is a very viable way of trading your butterflies with a broken wing. I wouldn't use it as an end-all, be-all, as the solution to paying cheaper prices, because you're definitely giving up a lot by doing that. You're giving up a lot in terms of the potential for your trade, at least for the majority of the instances that you'll experience. What I mean by that is that there's only so many trades that are going to get inside the profit tent. And when you are playing the profit tent in that manner, that only comprises about 10 to 15% of the trades. And yeah, you might be able to get much cheaper, but that also means that the trades that never reach the profit tent are also not going to be as fruitful. But we can look at the math and then go from there, and I'll show you the difference and the potential caveats to doing that. There are times when, let me just say this, there are times when gamma or volatility is low enough that it makes a lot of sense to do a broken wing. But in most cases, a symmetrical fly is definitely where you want to be. And for me, it's about being consistent and then having something that you can measure from one trade to another and compare them and feel comfortable with it. But I do like playing with broken wings, but they are, from my point of view, an edge case trade. And what I'm really talking about today is an edge case as well. I'm trying to discuss those times when convexity isn't close by. What do? Do I opt for searching for it, or do I lean towards dealer gravity? And so that's what we're talking about today. All right, let me do this. I was going to put on a trade this morning. I don't know. Okay, so the market dropped down a little bit, and now it's moved up. All right, I'm not going to have a chance to put one on during the show, but I will. I'll just show you the trades that I'm setting up for today. That's dealer gravity. Go to trading view. I was gone these 3 days here. Last week, I was in Florida, down in West Palm Beach, at a traders conference called Trader Fest. It's a conference that was given by Tradier Brokerage and sponsored by the CBOE. As a matter of fact, they gave me this hat right here. See, it says CBO, that's the Chicago Board of Exchange. Nice hat. And I presented at the conference on Friday. So that's why I don't have any trades. But I did take a trade on Monday and Tuesday, and they worked out well. The first one was for about $300. The next one about $1,400. I shortchanged myself on the first trade because I could have stayed in and gotten a near pin trade had I stayed with the trade. But unfortunately, I had a meeting and I had to get out of the trade. That would have been much, much larger. I'm looking at these days. I'm not sure how profitable they would have been. So it's not useful for me to sit here and tell you what I would or wouldn't have made. But anyways, this is my trade setup for today, or something very close to it. So what I've been showing lately has been what I call a time warp trade. And it's a combination of our standard 0 DTE trade, but combining it with a Batman, which means above and below. So why are we doing a Batman above and below? We're in a particularly interesting situation with super low volatility, although volatility has actually risen a little bit this morning, which is a little bit different than what you would normally see. But we were, for the past week, in much lower volatility, 17 or lower, into what I call zombie land. And it appears whatever happened over the weekend, we've popped up significantly above, and now we're at about 18.2. Now, what happens when volatility pops up like that, the premium decay starts getting delayed and your long options start getting bloated, and that allows you to go slightly wider in terms of what you're going to do. But also you'll find that the overnight gaps start diminishing a bit. We didn't really have a huge overnight gap for today's trade, if any. And so it remains to be seen also what today will look like. Will we end up in a doji? Will we move? It doesn't look like we're moving very much. Today's trade is typically betting on two conditions: low volatility, which means increased premium decay, much less meat on the bone. That would require me to put a trade on maybe the day before, but being Monday, there is no day before. It would have been Friday, right? And the trade, if I had taken it on Friday, probably would have been too expensive. So this morning, I'm looking to put on a trade that is, I don't know, similar to our time warp, but I don't know that I'm going to put on a Batman today. In fact, I have to consider this, but later today, I will put on a Batman that is very similar to this for tomorrow. So it'll be a 1 DTE. Today, our normal 0 DTE trade would be the call fly, a 25 wide. It looks like pricing right around $1.40 for a center strike of 74.40. That'd be an okay trade to take today. Let's see if I can move this over. This should be over here, like that. There we go. There's today's trade. Tonight's trade or at the end of the trading day, we'll put a Batman on similar to these. See, these were put on the night before. And if you want to know more about our edge case time warp trade, I talked about those in last week's shows. When volatility drops dramatically, there's a sucking sound that just sucks the premium out. And you may have noticed over the past couple of weeks that we were getting a lot of our moves overnight in what's called the Globex session. And so in order to combat that, the fact that our 0 DTE trades aren't really performing well because there's not much price movement and all the premium is out of it and all the overnight moves are taking up our directional advantage, we trade a 1 DTE trade and typically put it on the night before and try to guard against that. So then we're capturing the overnight move and also recapturing the premium decay. So that's exactly what these two trades were last week. Then I left for for Florida, so I wasn't able to put trades on Thursday and Friday, or Wednesday night and Thursday night. In any event, this is our trade for this morning. How did I choose that? I'm going with the trend. I'm looking for convexity, so I'm trying to spend about 10% of the width of my fly. So the width of my fly here is 25 wide. Let's see what we can choose here. So let's look at a fly right around here, and we'll analyze a 25 wide. This will be a 20 wide. We'll just pick it up a little bit. Wow, that's pretty expensive. It's definitely not going to be there, so we got to go further out. Let's say 74.50, 74.25, and 74.75. Okay, so a 10% of 25 would be 250. This trade is $1.75. I would venture that if I try to get one strike closer, that I'm going to get closer to 250. So the point of today's lesson was to look at dealer gravity, or how delta is changing over our price range. And so we're looking for something closer, getting to 1 on our dealer gravity. And this is our secondary filter. So the closest strike we have to the money is 74.25. So that would be right here, 74.25. And we're at 2 on our delta. Delta's increasing relatively quickly, and you already saw that when I tried to place a trade that was just 2 strikes closer, it was tremendously more expensive. The best way that I can show you this is if I take a look at our platform. And so what I'm showing here is our fly-on-the-wall platform. And this is our convexity heat map. And this is showing me all of the prices for the various width flies. See, when you're in Thinkorswim, you can put a strategy on and you can see it. And then if you want to see how that compares to one that's 2, 3, 4 strikes out or a different width, you have to constantly be changing all the strikes, and it takes forever. Here, with our fly-on-the-wall app, we can see all the strikes at once and exactly where they lie. So, for instance, a 25 wide here. Let's see, do I have, okay. 25 wide here, right at about 74.45 is going to give us right around that 10% area. Then you notice as we go further out, I can get something 60 cents cheaper. I'm 60 cents cheaper there. That means I'm about 25% less just by going one more strike out. But look what happens when I come closer. If I try to get one strike closer, I'm almost $1 more expensive. That's crazy. So that's what I would be looking at right there. Do I choose the 10% rule, or do I go one more strike out? Now, dealer gravity would come into play here if the strike that's a little bit closer to the money wouldn't be a huge difference between our 10% rule and something maybe a little bit more. When I say 10% rule, am I trying to get exactly at 10%? It's almost impossible. Sometimes I'll get it a dime above, a dime below. I'm trying to get around there. But if I see a strike that is one strike further out that lets me get 25% cheaper, I'm going to be all over that. If I see a strike that is one further closer and it costs $1 more, there's no way I'm going to touch that. So what we're seeing there is a dramatic amount of convexity, and you can see it because of its coloration. You can see that here at 74.50, the center strike, it's at $2. Price is moving a lot here. And then $3 here, $2.20, $3. That's an 80-cent difference between a 74.50 and a 74.45 25 wide fly. I'm all about 10%. That's my rule. I'm there, and then I'm going to move up the chain if the price difference has changed dramatically, and which it has. So from here, I can go from 240 to 170. That's a 70-cent difference. Huge. That's practically a little over a 30% change in price just by going out one strike. And why you wouldn't choose that, I don't know. So that's what we're looking at. Picking the proper strike is super important. What I'm talking about is something very difficult to show in low volatility. But if there was higher volatility, this would all be flattened out quite a bit more. And the price differentials wouldn't be as big. But here we're going one or two strikes and we're having changes of 30, 40%, which is crazy. When volatility is much higher, it'd flatten out the gamma. Let me show you what I'm talking about. So we'll take these guys off and we'll put a trade up like this guy right here for $2.12. All right. If you look at the profit curve on this, it's really steep. And that's a consequence of us being in relatively low volatility. VIX right around 17. Currently, it is at about 18, or 17.19. That's it, right around there. So it's pretty low. And so you're going to see a really steep profit curve. That is actually your gamma. Gamma is the sensitivity to price, the value of your option with the sensitivity to price. And so it's super steep. Now, watch what happens if I were in a much more vibrant or active market. I'm going to take this indicator here, the VIX indicator, and I'm going to increase volatility and do a what if. And we'll increase it to, I don't know, like 23. Now, if you look at or 24, if you look at the VIX curve, it has flattened out considerably. And that means that my zero wouldn't be here anymore. It would be much further out here. In fact, I could move where zero would be. It would be way out here. And so now my profit curve is much flatter. Now, let's compare that to where we're at actually right now. I'm going to just reset it. You see that difference? That is a huge difference in the slope of that profit curve, all because of just volatility. So I hope you get an appreciation then for what we're dealing with. If we were just maybe a couple of weeks ago, volatility would have been at low 20s or so, and we would have been in this type of situation where price would be way out here and a flatter curve. And we'd have a much different situation. Also, instead of these red tiles that are in my convexity heat map being so close to the money, they would have been way up here. And you'll notice that's the way they are on the put side. They're way down here. There's hardly any red tiles showing on the put side. That's because there's more volatility built into those trades. And there's less into the calls currently. So we have a skewed market. So we can get much closer. What that's really saying here is that the market is pricing for a downward move as opposed to an upward move. So if you can get closer to the money, the market is essentially saying that it's not putting as much meat on that or probability on that. So they're going to give you the price that you want when you're closer. And as opposed to the puts, the market is saying, hey, we're more apt to think that the price is going to go down, so we're going to price it appropriately, and we're not going to give you a good price until you get much further out. So that's what you're seeing currently in this market. All right. Hopefully that makes sense. I'm showing the wrong screen. No. Yeah, of course I am. Let's show the right screen. Chrome. No, Firefox. There we go. So I was talking about all this stuff and you didn't have any idea what I was talking about. All right. I could see it perfectly, by the way. So here's our convexity heat map. And we can look at, and now what this is showing is the rows are all the strikes in your entire options chain. And then the columns are different width butterflies, 20, 25, 30, 35, all the way up to 50. And we're looking at a 0 DTE options chain. We can also look at tomorrow's options chain or Wednesday's, etc. But we're looking at today's. And the tiles are colored from light blue out to light red. They go from light blue to dark blue, then dark red to light red. And the further closer to bright red, the more of a change that you're going to see from one tile to the next. So right now it's a little scattered because we're early in the day. There's a lot more volatility, so pricing isn't as uniform, but later on you're going to see a very different view here. But if we're looking for a pricing on a 25 wide fly, I'm obviously not going to choose something super close like a 74.20. I don't want to pay nearly $9. I want to pay somewhere around $2.50. So we have a fly right here where we can pay $2.50. All right. So that's the fly that we're looking at currently. And we can pay $2.50 for that guy. All right. But that same exact fly, that's centered at 74.55. If I go one strike out, I could pay $1.62. I could go two strikes out, I could pay $1. Wow, that's more than 50% off. That's about 60% off. So let's put that fly on. Let's see what that looks like. So while I'm further out by two strikes, the price is way cheaper. Let's say that price moved, I don't know, 10 points, or let's say 20 points. So we're at 73.85, and we went all the way to 74.05. The value of that position right there is about $150, $146. Now I can compare that to the other guy, and its value is also 146, right at that same spot, right? So same move for one fly that costs $238 versus the other one that only cost me $1.17. Same move. The $1.17 one is 10 points further out of the money, but it gives you the exact same payoff for less money, right? So right here, I'm getting paid. I'll see, everything's moving now, but I pay. So I guess that's what I'd like to ask you. Would you rather pay, to make $150, would you rather pay $260, or would you rather pay $1.17? So that kind of proves my point there about convexity and pushing things further out, that a lot of people will complain that, oh, that's too far out, Ernie, I'm never going to make any money. But for the exact same move, you can make the same money or more and pay a lot less. So David said, this is like going to the secondhand store and looking for the item with the purple tag. Yes, that's exactly what it's like. But you're going to find it consistently. And if you search for the bargains, they're out there. Now, it's a little bit laborious going through Thinkorswim and trying to set up your flies and looking for the right price, and you can't really compare them. But here I can compare all of them with our tool, the convexity heat map. I can see them immediately. And I can also, I might even decide that instead of going 25 wide, I might want to go 30 wide now because I can get it at a much better price. Where you might not even consider a 30 wide in the past, but now you're looking at it and you're saying, damn, I could pay $2.30 for a 20 wide, or I could go two strikes out and pay $1.89 for a 30 wide. Now, why would you want to do that? Why would you want to go for a wider fly? Pay about the same amount of money, but choose a wider fly. For one, you're going to have a much greater profit potential. A 25 wide versus a 30 wide has $500 more potential in it. But that's not the only place where you're going to gain on such a trade. You're also going to gain on the gamma of the fly itself. In other words, the profit curve itself is going to be steeper on the wider fly than it is on the narrower fly. So what I'd like to show you then is a study that I did that shows something like that. I'm going to go to an old study that I did here. Let's see if we can get to it. It's up here somewhere. It's coming. There it is. All right, now I have to show it. Discord. Okay. Let's take a close look at this. wider flies, why I want a wider fly. We were talking about a 25 wide fly as opposed to a 30 wide fly. Let's start from very narrow to much wider and just show you what width makes, how big of a difference that width makes in a fly. And what I did here is I took all the butterflies of different widths, and they were all under the same exact risk to reward. And so I have something comparable. I can look at how much they cost each. And then I looked at their center strike price and what it was worth at half-hour increments throughout the day. So now I can tell how fast something is making money for me. All right, there's a question here. Hello, morning, how you doing? Is there a video on how to use your system or demo of all the features? The Fly on the Wall app isn't my system. It's a tool that I'm developing that's supporting our system. The service itself is a Discord service, coaching service, as well as courses and the tool. And you'll learn about trading extreme risk to reward or asymmetric trades and using convexity, trading out of the money flies. And so that's the service. So you can go down below and sign up for a trial, which is a paid trial, but it's 4 weeks. You can quit anytime you want, so there's little to no risk. And check it out. That's the best way. Or you can go back to any of the hundreds and hundreds of videos that I've done on trading this strategy over the past several years. So getting back to why width is better. Most people, when they choose a butterfly to trade, and particularly if they're going to go out of the money, they'll go for a much narrower fly because they believe that by getting it closer to the money, that they'll have a better chance of profiting. The problem is that those flies, they don't grow in value very fast. And so that's what this is demonstrating. A 10 wide fly doesn't grow in value until you start getting very late in the morning or in the afternoon. A 15 wide fly starts a little earlier, and then so on and so forth. This line over here shows you the rate at which they start making money and the rate at which they end up making money. So you can see very clearly that as you go wider, you make more money faster with a wider fly. And at the end of the day, for the price that you pay for it, you make significantly more return. And so that's what this line here is showing. And you can see it graphically over here on the right, how your profit potential grows as you go wider flies. So what this is really telling you is that wider is better. It's as simple as that. Wider is always better. And further out of the money, if it gives you a convex price, is also better. Now, the purpose of today's presentation is to show and it's hard to show it right now because we're in a low volatility situation. I probably should have taken that into account, and I might change up tomorrow and Wednesday's lesson, and maybe look at broken wing flies. Because when you're dealing with dealer gamma or dealer gravity and volatility is super low, there's not a whole lot of choice to make. When you're dealing with higher volatility and things flatten out because gamma is lower, there is more choice to make. And that would have been a more appropriate use of this particular presentation that I was going to give today. So I am like backtracking a little bit on what, now realizing what I had done. I chose really the wrong topic for this market. But that's okay. It gives me the opportunity to tell you what does work in a low volatility environment and start talking about width versus risk to reward. The main goal here is that you want to have the best opportunity for the price that you pay. And there are two factors that go into that: width and how far out of the money that you are. And what I'm really demonstrating here is that choosing something wider and further out of the money, if you can pay the same price, is way more worth it. Or even if you can pay less, as I showed a little earlier, you can go to a wider fly and maybe pay about the same price or so, or even a little bit less, and get the same profit potential for the same move. Now, that's cool for a small move, but a bigger move, it'll pay off even more. And that's what this is showing, that as we go wider, the profit potential starts growing dramatically for wider flies. I guess the lesson here, and I'll go back to the big head, is that trading options, and particularly things like the butterfly, are counterintuitive. You're much better off pushing things further out of the money. They'll cost you less, and they'll pay off quicker. You're much better trading things wider, even though it may sound like that you're paying way too much or whatever, and pushing them out. That'll give you the best of both worlds. There are certain filters that you're looking for when you're putting on a trade. One is that you never want to pay more than 10% of the debit when you're putting on a fly, an out-of-the-money fly. And the other is you want to make sure that risk to reward stays within some kind of range. A 10% of the debit will give you a 1 to 9 risk to reward. What you'd like is anything 1 to 9 or a little bit higher, or 1 to 15, 1 to 18 is even acceptable. That's where you'd be paying about 5% of the width of the fly. Both of those situations will do exactly what I've just showed you. It'll give you a greater return on the money that you spend. All right, I'm going to just read some of these comments. For adrenaline addicts, waiting till the last 10 minutes of the trading place your trade will get you going. The last 10 minutes, it's super hard. And we do have a strategy that we call a scalping strategy. But I agree with you that you'll get really high gamma in the last 10 minutes, or even the last, in this type of market, you'll have that kind of opportunity the last hour and a half or 2 hours. If you're in high volatility, you have to go right to the last 10 minutes. But I did a show on scalping, and you might want to take a look at that. In volatility levels like we have today, you could play that scalping game as early as 2 o'clock in the afternoon. So you don't have to wait for the last 10 minutes. All right, Christian says, I placed a 7260 that is 30 wide for 220, all right? And the app shows me prices between 195 and 215. Is it normal not to be filled? Well, the market's moving right now, and the spreads are pretty wide. If you want to get filled, what I typically do is I'll just increase my offer by a nickel or a dime each time in order to get filled. As long as whatever you're paying for is still within your range of risk to reward and under that 10% rule, then you're fine. So try that. Don't sit around waiting for something unless you are confident that price is going to move into your limit price. Often when you sit there waiting for something to happen and it ends up going in the opposite direction, you miss out on the opportunity. All right, here's a question by Anu. What is the relationship between expected move and volatility? And what width and premium rules should be honored? So obviously in higher volatility, you're going to get an expanded expected move. I don't particularly look at expected move because it's not really that useful to me. And I'll tell you why. I'll show you why instead of telling you. So what I'm going to do is show you a study that I did for expected move. Let's see if we can find it here quickly. Yeah, right here. This one here is a more accurate chart. All right. So this is plotting the moves, the daily moves in the market over the past 4 years, almost 4 years. And the expected move is this blue dashed line. And so you can see that a fair amount of time the market is moving within the expected move. But also a fair amount of time it is exceeding it. In fact, it exceeds it by about 19.5% of the time. And not only does it exceed it by a little bit, but often it is by double or triple or even more of the expected move. So is that because of volatility? Of course it's because of volatility, but it makes a really good case for not trading expected move. Expected move is extremely limiting. First of all, if you're always trying to capture things that are inside the expected move, that's super easy to do. I'm not sharing the screen again. Damn! I didn't know that I changed it. There it is. So this is the expected move. And as I was saying, in the green, that's where expected move is. In the red is where it exceeds expected move. And you can see that it happens quite often, and then when it does, by a lot. And this is one of the reasons why we trade the out-of-the-money fly. And that is because we're not, first of all, trying to get it inside the profit tent each time we trade. What we're trying to do is give ourselves an opportunity to get inside that profit tent, knowing that, and at the same time, if we're wrong, if it goes against us, that we're wrong super small. And if it still goes towards our profit tent but doesn't get in it, we still want an opportunity to make money. So that's what we do. And by trading this way, we can keep our drawdowns super low, and we can and then have an opportunity to make huge returns. So instead of having big drawdowns all the time, or even occasionally that wipe out days or weeks of your good effort, that never happens in our strategy. We simply move sideways. The moves that we get that are within the expected move, all of these in the green, will make money for us, and they'll offset our losses. But the moves that exceed it, and as you can see, it exceeds it by a lot and quite often, those are the moves that allow us to make huge returns. Now, to give you some idea of what that really means. And to do that, I'm going to show you I know what I'm going to show you. I'll show you exactly what the returns that we expect over time. So that means I have to change this again to Keynote. All right. There we go, right here. So this is our expectation. When we're talking about expected move, most of the expected move, the extent of it, when we put our trades on, will be right about where the edge of these two green areas are here. So by choosing the 1 to 9 risk to reward, we're typically putting on a trade where our butterfly will be positioned around expected move just like this. And so half the time it will go against us, and we price our trades so that if it does go against us, it'll not hurt us, and we don't manage the losses. We don't manage the losses because the risk that we take is our defined risk. We're expecting that. If it goes towards us, then we have the opportunity to make anywhere from 50 to 250% return on our risk. And that's all inside the expected move. Now, here's the interesting part. Those returns, which happen most of the time, that's the majority of our winning trades, they offset the losses. And those expected move trades that I showed you just a moment ago, let's see, do I have that? No. That expected move trade that I showed you a moment ago, where they exceed the expected move, those are the ones that get into here. And there we can see anything from a 250% return to well over 450% return, as high as 1,500% return on our money. And so those are the things that accelerate our account. And those are the things that result in a return like this, right? So they create what we would call a stair-stepped account and super low drawdown. So you see I have very low drawdown, never exceeds 6%. Here it just barely touched just below 6%, but most of the time keeping our drawdowns under 2 or 3. And then a nice smooth equity curve that allows me to compound. And you'll see, if you look closely, you'll see that this curve is starting to curve up, but with very tight performance. Now, this is exactly the result of trading the out-of-the-money butterfly with super low risk. What is the Sharpe ratio of your trading portfolio? On this one right here, it's 4. And yeah, when you say that's awesome, that might not capture just how awesome it is. But all of these trades, by the way, were taken inside my trade room in our Discord. And so you get to see all my trades. and they're all verified. I show all my receipts and everything. So this is all real money traded. A 4 is more in the category of a high frequency trading type of profit of Sharpe ratio. A good trader would be excited with a Sharpe ratio of 2. 3 would be like extraordinary. 4 is in a different category altogether. But you can see my average risk to reward is almost 1 to 10, and my max drawdown never exceeded 6%. But here's the big thing. Win rate, only 52%. My win rate typically ranges between 45 and 55%. And that's what I wanted to go back to on this here. When we take that trade at the money, we're not expecting price to go into our profit tent or even go towards our profitable area at all. It's a 50-50 shot. The difference is that I want to make sure that when it does go towards my profitable areas, that I can capture and make some halfway decent profit on it. And when it doesn't, I want to make sure that those losses are super, super small. The way you can get access to it is by I'll show you, going right here. Going to Fly on the Wall, flyonthewall.ai. Go to flyonthewall.ai and you can take advantage of our 4-week trial. It's a week-by-week trial, so you can cancel at any time. And let's see. Here it is, live. Let me bring it up live. Here's our website. There's me. And then here's the offers. There should be a link down below in the description of this video. Okay. So let me go back to the big head. I wanted to say that last week I was at a trader conference, and it was the Trader Fest. It was given by Tradier Brokerage and sponsored by by SIBO, the Chicago Board of Exchange. And I was the final speaker at the conference. We'll get a chance to see that video sometime in the future, but everything that I talk about here is exactly what I talked about there. And it went over very well, by the way. So I got my SIBO hat. SIBO. Anyways, if you would like to join, there it is, flyonthewall.ai. All right, everybody. I'm going to, tomorrow, I've decided that I'm going to switch it up. This was the wrong time to really talk about dealer gravity. It would be much more impactful when we have much higher volatility. But it looks, and I was expecting a little bit more volatility. That's why I was deciding to do it. But it doesn't give me a good opportunity to show how you can use dealer gravity because there isn't a big enough range of prices in order to make that kind of decision. So we won't do that today. Tomorrow we'll talk about broken wing flies. So if you're interested in that, show up. I want to thank everybody for coming here. Give this presentation a thumbs up, and we'll see you tomorrow. Peace.